Right. Good morning and welcome to the 713th meeting of the Economic Club of New York. I'm John Williams. I'm the president and CEO of the Federal Reserve Bank of New York, and I'm chair of the club. The Economic Club of New York is recognized as the nation's leading nonpartisan forum for discussions on economic, social, and political issues. More than 1,000 prominent guest speakers have appeared before the club over the past century, and we've established a strong tradition of excellence. I'd like to extend a warm welcome to students joining us today from City University of New York's Graduate Center, Rutgers University, and Columbia University. I'd also like to welcome members of our class of 2023 fellows, a select group of diverse next generation leaders in our largest class ever. So today, I'm honored to welcome our special guest, Mark Zandi. Mark is chief economist of Moody's Analytics, where he directs economic research. He's on the board of directors of MGIC, the nation's largest private mortgage insurance company, and is the lead director of Reinvestment Fund, one of the nation's largest community development financial institutions. And Mark is co-founder of Economy.com, which Moody's purchased back in 2005. He's an advisor to policymakers and an influential source of economic analysis, often quoted in national and global publications. And Mark frequently testifies before Congress, and conducts regular briefings on the economy for corporate boards, trade associations, and policymakers. He's the author of 2 books, including Paying the Price, Ending the Great Recession, and Beginning a New American Century. Mark earned his bachelor's degree from Wharton School of the University of Pennsylvania, his PhD from the University of Pennsylvania. So today, we'll have a conversation about the economy and Mark's views on the economic outlook. And as a reminder, the discussion's on the record, and we do have media on the line. And I know we've got some questions from members of the club, which I've incorporated in some of my questions. And if we have time, we'll take questions from audience members, which you can submit via the chat box. So with that, Mark, welcome to the Economic Club of New York, and looking forward to our conversation.
Thanks, John. I want to thank you and the club for the opportunity to participate today. I remember we had a conversation about a year ago, and I'm sure no one remembers what I said. I don't remember what I said, but I will say I got it all right. So hopefully I got it all right this time as well.
All right. Well, let's start exactly at that point. So we're now in the middle of July of this year. So why don't you give me kind of the big picture view? So what's your view of the U.S. economy? Where are we today, and where do you see us headed?
Well, it's the economy's struggling. Inflation is obviously too high, painfully high, and if the Reserve is raising rates aggressively to quell that inflation. And historically, when we're in a world of high inflation and high and rising interest rates, the economy struggles, often lands in recession. So recession risks are uncomfortably high. But I will say, and I don't want to be Pollyannish, I think risks are high, but I will say I think we can navigate through. The economy will be able to navigate through without suffering an outright economic downturn. Economists talk about recession, and the opposite of that is termed soft landing. That doesn't feel right to me, John. I don't think what is dead ahead here over the next 12, 18 months is going to feel anything like a soft landing. I think it's going to be very uncomfortable, but I call it a slow session, not a recession, but an economy that's not going anywhere fast. And I think that's what we're going to experience here. So, but I think odds are that we'll be able to make our way through without a downturn. Here's the dreaded 4 words. This time is different.
Okay. So let me pin you down on this. I noticed that the other economic forecasters have been asked the question, what's the probability do you attach to recession happening in the next 12 months? I'm looking at the Blue Chip survey, which just came out. So what's your answer to that question? What do you think is the probability of the U.S. economy entering a recession next year? I assume you're saying that we're not currently in a recession, but you should answer that too.
Oh, yeah, right. This is not a recession. I mean, we're creating a boatload of jobs. Unemployment is rock solid, mid 3% range. So that's not consistent with the idea that we're in recession. I think the odds of a recession, kind of a NBER defined recession, broad-based across lots of industries, persistent more than a few months, kind of economic downturn starting at some point between now and this time next year is probably 1 in 3, about 1/3 probability. So it feels like about half, maybe a little, not quite half the probability of the of the blue chip consensus. I have gotten more confident in the view that we will avoid a recession. If you'd asked me, we had this conversation, say 3 months ago, 6 months ago, I might have said a probability of 1/2. So, I think we're moving in the right direction here. Still, 1 in 3 is still uncomfortably high. I mean, kind of in a typical, well-functioning economy, given the length of the business cycle, you'd probably say, 15% probability would be kind of, average, typical. So 1 in 3 is still elevated, still uncomfortably high, but I'm more optimistic. And I think I said this, probably said this last year as well. I'm more optimistic than, the consensus view with regard to recession probabilities.
So given you said it's about 1/3 probability, it sounds like you don't have a recession in your baseline or your modal outlook for the U.S. economy over the next year.
No, we don't. We have slow growth, slow session, below potential growth. Unemployment does start to move higher. I have the unemployment rate by this time next year, just around 4%, a little bit over. But no recession in our baseline forecast. Now we do a lot of scenarios, obviously, and not hard to construct a recession scenario. It's pretty easy to do in the current context. When the economy is growing so slowly, it's very vulnerable to anything else that can go wrong. At the end of the day, we were talking about this earlier. A recession is a loss of faith. Consumers lose faith that they're going to hold on to their job, and they run for the bunker, stop spending. It's a loss of faith that by business people that they can sell whatever it is that they produce, and they start laying off workers, and you get into this kind of self-reinforcing negative dynamic. When the economy is growing slowly, and if anything else goes slightly off script, off the rails, people lose faith, lose confidence, pack it in, and we go in. So, we are vulnerable, but I don't think we're going into recession. We need a little bit of luck, no shocks, and we need some reasonably good policy making, particularly from the Federal Reserve. That it's very tough to, raise rates high enough, fast enough to get inflation in, but not too high, too fast that it undermines the economy or breaks something in the financial system and the economy. So it's not going to be easy, but I think with a little bit of luck and some reasonably good policy making, we should be able to make our way through.
Yeah. So, Mark, one of the things you mentioned was that you've actually lowered your probability of recession. That from before, you feel actually somewhat more maybe positive about the economy. So, have you been surprised by the strength and the resilience of especially the labor market over the first half of this year? And why do you think that? If so, what do you think's going on?
Yeah, I have been surprised. Not in terms of output GDP. That's pretty consistent with what I expected. Although, maybe in the first half of this year, it looks like we're going to come in around 2%, which is probably a bit higher than I would have thought, late last year, this time last year. But the real surprise has been the resilience of the labor market. I mean, it's been really just amazing to watch. The unemployment rate's at 3.6%. That's about as low as it ever gets. And it's been there for more than a year. I mean, it's kind of been rock solid, give or take, and producing a lot of jobs. I do think job growth probably is slower than what we're observing in the current data, that we will get revisions, and they will likely be downward revisions. So I don't know that we're creating 200,000-300,000 jobs per month, which is what we're experiencing, what the data says currently. Probably something closer to 150 or 200,000 when all the revisions are in. But nonetheless, the labor market has been extraordinarily strong. My sense is that the reason for the resilience is this kind of concept of labor hoarding. I think businesses are very reluctant to lay off workers. They know that whatever is on the other side of this, they will be left with a very tight labor market given demographics, the aging out of my generation, the baby boom generation. We are now retiring en masse, and immigration is vexed. There's been some recent pickup in immigration, but I suspect that the immigration will be less in the future than it has been historically. We can't rely on as many immigrants coming into the country to help with the labor supply. So I think businesses understand this, and of course they've been living it, right? I mean, even before the pandemic, the number one business problem was finding and retaining workers. And of course, the pandemic just exacerbated those labor market problems to an nth degree. So businesses are just hypersensitive to this. And again, they're going to be reluctant. Now, we've seen some pickup in layoffs since the beginning of the year. I mean, if you look at initial claims for unemployment insurance, they were 200K maybe per week, which is extraordinarily low. We're now maybe just south of 250, which would be consistent with kind of a more normal, well-functioning labor market. But I think the fact that layoffs are as low as they are and businesses as reluctant as they are to lay off workers has been the big surprise, here, and the reason why the labor market has been so resilient.
Does that worry you a little bit that businesses are really holding on to employees, worried about, that it's so hard to, refill those positions, that could be, if this kind of, you mentioned confidence were to slip or recession were to take hold, that maybe we'd see more rapid fall in employment or something? Is that something that you worry about?
Yeah, possibly. I mean, you make a good point. I mean, if businesses are holding on to workers, they're not as productive as they need to be or have been historically. It's cutting into profit margins and profitability. We could get to a tipping point in if we actually go into recession for whatever reason, another shock or a policy error combination. That at that point businesses will regurgitate labor en masse, and we see a big pop in unemployment. So that I think that's a real possibility. It didn't happen, I don't think. The last time it felt like we were in a kind of a similar environment in the late 90s around Y2K. You may remember how tight the labor market was then. Felt like there was labor hoarding going on, and we did suffer a recession. We had the tech bust, and then we had 9/11. And labor market did weaken. It was a recession, at the end of the day, but it didn't feel like there was this mass throwing of labor onto the labor market and unemployment. So that historical case study would suggest, it's probably less likely, but certainly can't rule that out as a possibility.
So you said you've been positively surprised by the resilience of the demand for labor. What about the supply side? So what are you seeing there? And also on labor force participation, you mentioned immigration, but so more generally, are you encouraged by developments in terms of supply side labor?
I have been, yeah. I mean, unemployment's rock solid, 3.6% more than a year, and that despite the very strong labor demand, a surprisingly strong labor demand, and the reason is because we've gotten a surprisingly good labor supply. I mean, if you look at labor force growth, it's been extraordinary. I mean, over the past year, I know I'm a little nerdy. I just know this number: 2.9 million people entered the labor force over the past year. You divide by 12, that's a lot of people entering the labor force. Labor force participation has improved until recently. In the last few months, it's kind of stabilized. But the real, surprise on the labor force side has been the growth in the working age population, and it really goes to those foreign born. If you look at if you go to the Bureau of Labor Statistics and labor force, you can see foreign born and native born, and foreign born has really taken off here. So I think immigration has picked up in the near term here, and that's been very, very helpful in helping with labor supply. There's still some pockets of I think potential labor supply. I mean, we were talking about this as well earlier. One demographic that hasn't normalized in terms of their engagement with the labor market is folks over the age of 65. So historically, people retire, and then many of those people who retired come back into the workforce for various reasons. When the pandemic hit, those people left, but we haven't seen the same kind of return rate on the people who've retired. And their participation rates are lower than they were pre-pandemic, the folks that are above 65 years old. So that may be a pocket of potential labor supply going forward that could be helpful. And, maybe those retirees aren't coming back because they're enjoying pretty high stock values and housing values. I mean, I know stock prices are down from their peaks, and housing values are below their peak, but they're still much, much higher than they were before the pandemic hit. Or could be some of the excess saving. Households did a lot of excess saving during the pandemic, they were sheltering in place and weren't spending, and they have cash in the bank and they don't need to come back. I'm not quite sure, but maybe that's a pocket of potential labor supply. I don't expect the strong labor demand, labor supply to continue. I think that's going to moderate as we move forward here. But both have been a surprise to me, certainly over the last 6-12 months.
So you talked a lot about the unemployment rate being 3.6, being rock solid at this level, near 50-year lows. So what is your view of full employment? Like, what do you think of as the natural rate of unemployment, or how do you think about that? Is that a sustainable level of unemployment? Is the labor market really tight, or how do you gauge that?
Yeah, it's a great question. I in my official forecast, if you go look at the numbers that we produce, the NARU, the natural rate of unemployment, the rate that's consistent with non-accelerating inflation, is about 4%. But my intuition is that it's lower than that. It feels like 3.6% where we are today. That's a strong labor market. That's a tight labor market, but that feels like full employment to me. The gauge for that is wage growth. Wage growth is elevated, but it has been moderating despite the very tight, low unemployment and tight labor market. And feels like that's going to continue to come in. My view is that the reason why wage growth took off is not so much the tight labor market, although that helped. It's really a jump in inflation expectations that occurred back, particularly when Russia invaded Ukraine, and we saw this jump in oil prices. That you remember back, John, a year ago. I know in New York you're paying a lot more for a gallon of gasoline than anywhere else in the country, but nationwide we were paying $5 for a gallon of regular unleaded, a record high. And I think that those oil prices, gasoline prices, play an outsized role in people's formation of expectations about future inflation. And with oil prices, gas prices coming back in, today we're now at $3.50 nationwide for a gallon of regular unleaded. That's allowing inflation expectations to come back in and allowing wage growth to come back in. In fact, New York Fed, I think it was yesterday, right? You came out with your inflation expectations measure, and that showed another improvement. I think you were at 3.8% for 1 year ahead inflation expectations, which is still elevated. I think pre-pandemic it was kind of hovering around 3, but that's well below where it peaked, and it's definitively moving in the right direction. And hopefully, oil and gasoline prices stay down. So, and there's other reasons to think that 3.6 might be consistent with full employment. I mean, that was the unemployment rate we had pre-pandemic, right? And wage growth and inflation were not issues. In fact, just the opposite. Inflation was, remember, too low. It was below target, and Federal Reserve was working really hard to try to get that inflation rate, back up. Here's the other thing that I don't get. Maybe I'm curious. I know I can't ask you questions, but I'd love to know what you think. How can the labor market be at full employment when we're getting so much labor supply? I mean, we're getting 200 to 250,000 people entering the workforce each and every month on a consistent basis. Is that at all consistent with the idea that we're at full employment? And so I'm of the mind that 3.6, it's tight, no doubt about it. But we want a tight labor market. We want everyone employed. We wanted people, a high intensity labor market. It helps the people that are on the fringes of the labor market, the minority groups and people that are typically disenfranchised from the labor market. And I don't think it precludes us from, getting wage growth into a place where it would be consistent with inflation at the Federal Reserve's target.
So you brought up a couple of interesting points. One is you have your official forecast, and then you have your intuitive or gut forecast. And I'm wondering, do you have this debate at home between which forecast is the right one? But I think you've explained that. But also, what about the other indicators? You mentioned unemployment. That's been kind of constant at 3.5. Other indicators have definitely been moving quite a bit over that same period of the past year. Job openings have come down. Job quit rates have come down. You mentioned unemployment and insurance claims have moved up. So what signal you getting from all these other indicators, given that the unemployment rate has almost been constant over the last year?
Yeah, I mean, it's a great question about, your model is saying this and your intuition is saying that. I've learned a lesson because I've been at this for a long time. 35 years plus as a professional economist building models. you have to have the courage of your conviction in the models that you use. And the modeling says, in all the work that we've done trying to estimate the natural rate, and not too dissimilar from I know what the CBO does because I'm on their board of advisors and I see what they do. Very similar kind of approach, and the modeling says 4%. I think to be precise, 4.2%. I think that's our estimate of the natural rate. The full employment unemployment rate. But, and then I think you have to stick to your models. I mean, I learned that the hard way back, prior to the financial crisis when forecasting and modeling house prices, which were obviously very key to what happened in that period. And I can remember the model said Miami house prices need to fall 90%. And I can remember talking to my housing economist. I said, if we put that out, we're going to lose all credibility. So we did the add factor, and the decline was 40%, which, by the way, was a strong statement. 40% decline in house prices. Are you kidding me? But John, you know what prices fell in the pandemic? In the financial crisis in Miami, they fell 90%. So you have to have the courage of your conviction of your models. But so that's my intuition. But we're very model based, very quantitatively based. In terms of the other labor market indicators, they all seem to indicate to me the labor market is easing up, that it is becoming less tight. I mean, you mentioned vacancies, unfilled positions. They peaked at over 12 million back in March of 2022. We're now around 10. And I suspect that's from the JOLTS, the Job Opening Labor Turnover Survey. I suspect it's actually less than that. The JOLTS has got survey problems. The survey response rates are very low. And I sense there's some bias there. If you look at other measures of vacancy, coming from some of the private organizations that look at these things, it feels like it's probably closer to 9. And just for context, prior to the pandemic, it was 7 to 7.5 million. So it's still elevated. The other thing I'd say is if you go look, I think there's been a kind of a long run secular increase in vacancy. It just goes to the fact that the cost of posting jobs and keeping them open is a lot lower today than it was 5, 10, 15 years ago, given, online. I mean, if you go back 10, 15 years ago, businesses were still posting help wanted ads, and that was very expensive. Now it's costless. You open a position, you keep it open. So I think there's been a long run kind of secular increase in the amount of vacancy in the economy relative to other measures of labor market tightness. Hiring rates have, they've pretty much normalized, maybe a little on the high side. I mentioned layoffs; they've normalized, maybe on the low side, but they're pretty close. They're within spitting distance of what you would expect to be would prevail in a kind of a well-functioning economy. Quit rates have come in. I know they bounced a little bit last month, but they feel pretty consistent with long-run historical norms, and that's really important to wage growth because it's when people switch jobs that they get that wage bump, that kind of drives some of the wage growth statistics. That feels like that's normalized. Employment to population, that's a little elevated. I look at the prime age EPOP, 25 to 54-year-old. That did jump, that increased a little bit in the month of June. So it's a little on the high side, but like all the other indicators say, yeah, the labor market feels a little on the tight side, but not screamingly tight. Not like, we are well past full employment. I don't get that impression, and I do think we're moving in the right direction on that the labor market is, easing up a bit here, and that should allow wage growth to continue to get to normalize, get back to something more consistent with, our inflation targets.
So you mentioned, the official statistics and how those fit together and what you take from that. You also mentioned that there's some other, I think, newer time series and data that you're looking at. So you said you've been in this business for 35 years, but let me focus on the last 3 or 4 years of the pandemic. What has been the biggest change for you in terms of what kind of data you're able to access and use and apply to thinking about these kind of macroeconomic issues, in addition to all the official statistics that we all know?
Oh, yeah, it's been a cornucopia of new data statistics to look at. And New York Fed's been great at this, right? I mean, you guys have been very good at putting out new data sources and information. I mentioned the inflation expectations, but there's a blizzard of, from supply chain stress to, so forth and so on that has been, and a lot of the Federal Reserve banks across the country have been doing, roughly the same thing, that have been very, very helpful to look at. And Moody's is also very aggressively working on producing data and data sources. For example, we have very good data on corporate credit conditions for private companies. It's pretty straightforward to get the data for publicly traded companies. Pretty hard to get it for private companies, but that's really key when we start thinking about the risks and what's going on in the financial system and the shadow system and the private credit market. So that's been very important data. We collect a lot of data that's coming from financial markets. So we're looking at, for example, CMBS delinquency and default rates. CMBS being commercial mortgage-backed securities. Obviously, CRE, commercial real estate, is an area of potential risk, and we need to watch those credit statistics very, very carefully. Other organizations putting out data that's really valuable, like Equifax, the credit bureau. I know New York Fed uses this data, gets a 5% randomized sample, and uses it for constructing estimates of what's going on with household balance sheets. But we get all credit files for every person in the country every single month, and we get consumer level files that we can look at and see, what's happening with credit conditions, for different demographics, by income, by age, by vintage, by score range, all these kinds of things that are very in the housing. Think about the housing market. Think about the data we had pre-financial crisis on housing. There was really, very little, pretty much nothing. And think about what we have today from places like Zillow and CoreLogic and Yardi Systems and Redfin, and I go on and on and on. We've got multiple house price measures that we can look at, from the FHFA to the CoreLogic. We produced our own repeat sales indices. Same with commercial real estate. So I can go on and on and on, but there's just a blizzard of information out there that's enhances our ability to look at all those things. By the way, John, and I know we'll come back to this. This is why, to some degree, I think I will always have a job, because it's just interpreting that data and understanding the advantages and disadvantages of that data. I don't know, maybe AI can do that. I'm not sure, but I feel pretty confident that there's going to be a need for economists as long as we're producing as much information and data as we are. And
Mark,
separating the signal from the noise is pretty hard.
We'll come back to that question later, but I want to turn to inflation. And obviously, as you started your comments, this is a very important issue, and understanding that. And we have a CPI release coming out tomorrow, and I don't know. So let maybe start with, how do you see inflation coming out in the next release, and then we'll turn to kind of the broader contours of how you see inflation developing over the next year or two. But why don't you start with how you're viewing the near term inflation numbers?
Sure. John, I get nervous on 2 days of the year at 8:30 in the morning. The first Friday of the month, which is Jobs Friday, I get nervous. I don't know what it is. And then, of course, this now in the last couple 3 years, the CPI report that comes out, the Wednesday of the second week of the month, and we're getting that tomorrow. I actually, John, I'm feeling pretty good about that report. I think. And I've got a great team, and one fellow who spends a lot of energy on the CPI and trying to understand what that's going to be, in the month. And we expect a increase in the top line CPI of 0.2, which will put year over year closer to 3%. As you remember, June of last year, when gas was at $5 a gallon, CPI was 9%. We're now at 4, and this would suggest we're going to be closer to 3 on a year-over-year basis. And here's the one that I think will be surprising. On core, excluding food and energy, it should be also 0.2. It could be 0.3, because the actual estimate we're coming up with is 0.24. So that would be revised down. So I'm hoping for a little bit of luck and we get the 0.2, not the 0.3. But nonetheless, it's still much better than what we have been getting. That would put core year over year at 5%, which is, again, still way too high. Got to keep moving south here. But those are the numbers. My own view is I feel pretty, as it's become pretty clear, I forecast a lot of things. Some things I forecast I'm very confident in, some things not so much. I'm increasingly confident that inflation is going to continue to come in here. And I do expect vehicle prices to roll over. Here's another. We construct used vehicle price indices every month based on actual transactions. In the month, I just got this data this morning. In the month of June, used vehicle prices fell by 3.2% month over month, 9% year over year. And that's going to get translated, in the CPI here going forward. New vehicle prices have already started to roll over as we get more production overseas and inventory start to build. And here's the other thing that's going to happen. The cost of housing services, which of course adds significantly to measured inflation, particularly in the CPI given construction, that's going to moderate, very significantly here over the next 6-12 months, because that goes back to rents, and rents have gone flat to down since the end of last year as we've gotten a lot more multifamily supply, as supply chains have eased and a lot of multifamily property that's gotten bottled up in the completion process, finishes and gets completed. And demand has been soft because of the previous surge in rents. Housing's just not affordable. Single family is not affordable because high house prices and high mortgage rates. And now renting a home is also unaffordable for many households. So we're getting demand destruction. Households aren't forming. So softer demand, more supply. That means vacancy will continue to push up. That means rents will be flat, and we should get, a lot of progress on that. And then the last piece, and then I'll stop, is, and actually this framework I'm laying out for you is the same one Jay Powell put forward in his speech not long ago. He's talking about goods prices and housing, and then ultimately service price inflation, so-called super core inflation. That goes back to the cost of labor and wage growth. And as I mentioned earlier, my view is the labor market we are close to full employment, but it is easing. Inflation expectations are coming in. So I expect wage growth to continue to moderate, get back to get something more consistent with underlying productivity growth, and allow super core inflation, service price inflation, ex housing and energy to come back in. So my own view is that by this time next year, certainly by the second half of this year, next year, we should be close enough to the Federal Reserve's target that it won't be nearly the issue as it is today.
So, one way that economists often think about inflation and disinflation that you were just talking about is in terms of what's called the sacrifice ratio, that if you want to bring inflation down, you have to have unemployment above its long run natural or neutral rate that you already discussed for a certain period of time by a certain amount. And that's kind of a conventional way of thinking about it. But you just mentioned that CPI inflation, at least overall CPI inflation, reached 9%, and now you're forecasting it to come down to 3% this year, and without any, so far at least, any movement in inflation. So is the sacrifice ratio concept, is that dead? Does it just not apply to the situation now? Or do we still have this, what some people are referring to as the last mile? That, for the reasons you've discussed, inflation has come down, the reversal of the gas prices, things like that. But we still have this, as you mentioned, the super core inflation that may be more costly to bring that back down. So how do you think about kind of the traditional ways of thinking about inflation and disinflation versus how that applies into the current situation?
Yeah, I believe in the sacrifice ratio, but I don't think it applies to a strong degree in the current context. Because in my view, the reason why we're suffering high inflation is not because of an overly tight labor market and because of accelerating labor costs. It's the supply shocks. It's the obvious. It's the pandemic, the impact that had on supply chains and labor markets, and still to this day. I mentioned vehicle prices. The reason why new vehicle prices are elevated is because the Japanese and Germans can't get production up because their supply chains are still a mess because of what happened to China up until the end of last year and because of the Russian-Ukraine war. And the Russian war, I think that did a lot more damage than is commonly recognized. It goes back to the fact that it's caused oil prices to jump. We saw WTI at West Texas Intermediate over $100 a barrel, gas take off to record levels. And it's at that point that those two supply shocks kind of came together, infected inflation expectations. They jumped, particularly consumer inflation expectations, bond market as well, but mostly consumer inflation expectations. And that's when the whole thing metastasized, became a broader inflationary issue. If that diagnosis and the demand side, labor market tightness, they're kind of I'm not arguing they don't matter. They just matter a lot less. And so if that diagnosis is correct, then that suggests as the pandemic effects and the Russian war effects move further and further in the rearview mirror, inflation should be able to come down without higher unemployment. There is no sacrifice ratio. There's no sacrifice there. Now, having said that, I do think there is an element related to what's going on in labor markets. The labor market is tight, and I do think we do need to see some easing in labor market conditions. Maybe we go from 3.6 to 4.41, and that will be enough to take enough pressure off wage growth and other in labor costs more broadly to allow us to get to close that last mile and get service inflation and get back to core. But here's, John, I'll say one more thing about this. And this goes back to monetary policy and recessions. In my view, if we get inflation back to 3 and you start seeing a 2 handle, why in the world do we need to even sacrifice? Why do we need much higher unemployment to get that last mile quickly? I mean, do we want to sacrifice the economy to the altar of a 2% inflation rate when, by the way, I'm not sure anyone believes that's the right inflation target? I mean, if you canvass economists and say, hey, what do you think the appropriate inflation target is today? They probably say something like 3, not 2. So now I get it's important to continue to argue that we should get to 2 because it keeps inflation expectations anchored and makes it easier to get to 2. But on the other hand, do we really want to do that? So, my sense is we get, down to 3, headed into the 2s, moving in the right direction. That last mile becomes a lot less important at that point in time, and we become a lot less, worried about that. The sacrifice doesn't need to be a recession, to get us back to target.
So you mentioned inflation expectations a number of times in a different context. You talked about how that accelerated wage growth, and it's obviously an important part of this narrative that you described. And you mentioned how inflation expectations have longer-term inflation expectations have remained relatively stable, and those short runs have moved up and then come back down. And by the way, the New York Fed's survey of consumer expectations, newyorkfed.org, it's there, published every month, along with all those other indicators that Mark so kindly mentioned, including, I think, the supply chain index and others that we have there. So let me just ask about inflation expectations. So how do you think about this? And if you have a pretty positive outlook both on the economy and inflation, but what could go wrong? I mean, one question that you hear a lot of, well, what happens if inflation ends up being more persistent and inflation expectations become unmoored at a higher level? So talk a little bit about that risk you see relative to the kind of the baseline, pretty optimistic or positive view of how things will play out.
Yeah, well, I brought up oil prices a number of times. In my mind, that is the key threat. I mean, we've actually been pretty lucky with regard to oil prices. That surprises me. It has been a big surprise to me as well that they've been as low as they have, given the sanctions that the U.S. and Europe put on Russian oil. It goes to the market has gracefully adjusted to those sanctions. The oil has just simply been diverted into China, India, other places we don't know exactly where because the data isn't good enough to tell. But overall, Russian production has remained the same. By the way, that doesn't mean Russian oil revenues have remained the same. They have declined because of that oil price cap that the administration put in that seems to have been working reasonably well here in keeping prices down for Russian delivery. I mean, the Chinese are benefiting enormously from cheaper oil, but oil prices have stayed down. We're at $70, $75, depending whether it's West Texas or Brent. And that's lower than I would have said a year ago. Now, I do expect them to move higher. Oh, of course, the other thing that I should have mentioned is China, right? Chinese economy didn't really kick into the gear that we thought it would coming out of its no COVID policy at the end of last year. So demand for oil hasn't picked up as much as we thought. So that also has contributed to the low oil prices. That feels like a very tenuous kind of situation. Of course, the Saudis and other OPEC members want higher oil prices, and they've been curtailing production. So they could decide to curtail it significantly more, or the Russian war takes a bad turn, or Chinese demand does start to pick up. The Chinese economy kicks into high gear, and demand picks up, and we see oil prices go back to $80, $90, $100 a barrel. At that, going back to earlier points, because the economy is so soft and we're so focused on inflation expectations and wages, that'll be enough to do us in. So that's a the thing that worries me to a very significant degree. If I'm wrong, that very likely would be why. Other potential reasons why, but that seems like the most likely way we would go off script here in a meaningful way.
So we've got 2 more minutes, I think, roughly, and we got 2 final questions that I wanted to make sure we covered, but we have to be relatively quick. So you mentioned risks to the outlook, you mentioned oil prices, you talked about China a bit. We've had this inverted yield curve for a long time. It's very inverted. There are signs, some signs of, back from March with the banking stress that, the banks are tightening lending standards. So how do you think about that in terms of the risk of the outlook?
I think it's a very significant risk. Now, I think we dodged a bullet with the banking crisis back in March, in large part because of the very good policy response. The Bank Term Funding Program that the Fed established was very helpful, and the way Treasury and other regulators stepped in and resolved troubled institutions very quickly, insured deposits whether they were below the 250 limit or not. I think that was very helpful. But I don't think the fundamental underlying problems have been addressed. I mean, the fundamental problem is this inverted yield curve. It's putting a lot of pressure on the banking system, financial system more broadly. And banks and others can navigate around that for a while. They hedge, they match. But over time, those hedges become too expensive. They can't match. Their net interest margins are going to come under significant pressure. And then at that point, credit availability is going to be impaired. And then something else in the system can break. I have this image in my mind. The financial system is doing this. It's hanging together. The pressure of the interest rates on it's shaking. You can do that for so long. But at some point, I don't know if this is still there's such a thing as a gasket, but a gasket will blow and we got a problem. So I don't think the script has been totally written. And by the way, just because we're running out of time, I'll throw into the mix. All this has happened so far without any credit problems. I mean, credit risk has been a non-issue. That's going to be an issue. That's even if it's simply credit problem simply normalized, that's going to put added pressure on the system. So I don't think we're done here. I think, and that's the one thing that really worries me about my scenario. No recession, inflation takes longer to come in. Federal Reserve has to maintain a tight monetary policy for longer, which I think is the case. And that means that system is going to be shaking and something can break. So in my mind, that's a very significant risk down the road.
And yet you don't have a recession in your baseline. You said something like about 1/3 probability of one in next year. So, okay, unfortunately, we don't have time to go into all those other topics because I want to get to the final question.
Yeah, sure.
The final question, of course, this is for the Economic Club in New York, where we have a lot of programming around artificial intelligence. So I have to ask you the question, is artificial intelligence going to replace all of us economists? Are we needed anymore when the algorithms will do the job for us?
Well, John, you and I, certainly me, your job may have changed in the 35 years, you've been working as an economist. My job today is almost precisely the same as it was 35 years ago. And by the way, just a quick mention, the first project I got that I used as a basis for starting the company I ultimately sold to Moody's was a bank, a New England bank, Shawmut Bank. I don't know if you remember Shawmut Bank. Was it discriminating in mortgage lending? Because at the time, if the Federal Reserve, the Boston Fed determined that it was, then it could not acquire other banks and they would be acquired. So they hired me and I used a neural net. No lie, I used a neural net to help me with that. That is AI. So AI has been around for a long time and I still have my job, John. I still have my job. So I'm hopeful. I'm hopeful that I will continue to have my job.
Well, thanks so much, Mark, for joining us. And a couple notes I have for, we get together maybe a year from now. We've written down your forecast this time.
Oh, no.
So we're going to, I got stuck to my screen. So next time I can go through how your forecast went right or wrong. And also whether, how artificial intelligence and all those innovations are affecting our lives. So again, thanks so much, Mark, for joining us today. But we'll have to wrap up now. So my job at the end is to just highlight some of the events we've got scheduled, starting with tomorrow. And we're going to have Mark back. We have tomorrow's luncheon event with Lael Brainerd, the 14th director of the National Economic Council. And so please add that to your list of events. Then on July 13th, we have part of our author series. We have a webinar with Andrew Oliveris, the former chair and CEO of the Dow Chemical Company. And then on the 19th, we have a webinar from another author series webinar with Ambassador Robert Lighthizer, from former U.S. trade representative, and he'll be joined in conversation by club member Fred Hochberg. Then on July 24th, we have a luncheon event with the Honorable Lena Khan, Chair of the Federal Trade Commission. And then on the 26th, we have Paula DePerna, author and special advisor to CDP, who will discuss her new book on a webinar with club member Abby Cohen. And then on July 27th, we'll host a webinar with Jesse Van Tol, President and CEO of National Community Reinvestment Coalition. So finally, as we wrap up, I'd like to take a moment to recognize the members of the Economic Club of New York Centennial Society joining us today. So contributions from the 362 members of the Centennial Society continue to be the financial backbone of the club. So thank you to all of you who have joined today, and we hope to see you tomorrow.